Welcome, Eric. So the Federal Reserve has what's called a dual mandate. So there are two things that Congress has set out for the Federal Reserve to do. The first is to get to maximum employment. That's generally thought to be around 4% unemployment. The current unemployment rate in the United States is 3.7%. That's a very low rate by historical standards. And you can see we have very, very tight labor markets. For those of you visiting in New York, you go into almost any restaurant or hotel, retail space, you still see help wanted signs indicating how tight the labor market. I live near Foxborough Stadium in Boston, near where the New England Patriots play, and normally those billboards are advertising products. They're still actually advertising jobs right now. So it just highlights that the labor market is unusually tight. The second aspect of the dual mandate is stable prices. The Federal Reserve interprets stable prices as being 2% inflation based on one of the two major indices that we look at, which is the PCE, the Personal Consumption Expenditure Index. So while we have a target in the United States for 2%, over the last year we've not come close to hitting that. The inflation problem is far more than just an oil story. It's far more than just a food story. It's really across categories. Shelter in the United States is really important. It's 1/3 of the index. Now, for those of you that are in the United States, you know that housing prices have been going up and so have rental prices. And this index shows that it's been going up at 6%. Now, the reason that's important is that tends to have persistence. So real estate's not a spot market. It doesn't go down really quickly. So if you're seeing a number over 6% for shelter, that's going to take some time for it to come down. If your goal is to get to 2%, if 1/3 of your index is well above 2% and has persistence, it's not going to be that easy to get inflation back down to 2%. Compensation is the most important expense for most businesses. So if labor costs are going up very quickly, first of all, like shelter, it doesn't turn around very quickly. And second of all, that persistence means that you're probably not going to get inflation back down unless labor markets start having a lot more slack than a 3.7% unemployment rate would indicate. Wages and salaries in the United States are going up 5.3%. So CPI is 8.3, wages and salaries are 5.3. So on average, over the course of this year, people have taken a 3% wage cut. Now, 3% wage cut tells you why the quit rate and why people are switching jobs so quickly. Because if your employer tells you you're going to take a real wage cut that's pretty significant, you're going to start looking around to see if there's somebody who's going to offer you a better wage. And when the unemployment rate is 3.7%, you might very well find an employer willing to pay you more than your current employer is. Unfortunately for the Fed, the U.S. economy is proving itself to be very resilient. And as a result, labor market remains tight, and even despite the rapid increase in the short-term interest rate that the Fed controls, we have yet to see the labor market weaken appreciably. People want to have a job where they can work remotely, where they don't have to go to work 5 days a week, in particular where they don't have to do face-to-face contact all the time. So that's a challenge for the U.S. economy, that there's a sectoral shift in the desirability of jobs, which is another impediment to the Fed trying to get wages to slow down, because these are really big and important sectors in terms of how many people work in these jobs. You can see going back to last December, not even a year ago, they thought the highest interest rate for the federal funds rate by the end of 2024 was going to be around 2%. They're predicting what they themselves are going to do. So obviously that wasn't a very good forecast. And you can see in particular, they've been raising the rate in the near term. So as you go from December to March to June to September, they've been ratcheting up their expectations for the rate that's necessary to get the inflation rate back to 2%. You're looking at that dark red line, and you can see that it has the Fed funds rate for the end of this year at a little below 4.5%. That would imply a 75 basis point increase at the next meeting and a 50 basis point increase at the following meeting. I actually think that's pretty plausible. So you can look at the US housing market and see that it is already having some pretty big difficulties. That's the most interest-sensitive sector. But you're also going to be seeing that consumers are going to be starting to slow down their own consumption. So my own perspective, one, I think inflation is going to be far more persistent. The Fed has been wrong about this over the last year. I think it's going to continue to be wrong. So the components that have the most persistence or serial correlation are all components that are well above 2%, that we're going to be able to get inflation down to 2% within a 2-year period, and I doubt we'll be below 3% by the end of next year. And part of my concern is wage inflation is so strong right now. So in order to get that wage inflation to come down, you're probably going to have a much weaker labor market. And by much weaker, I'm not talking about a 4.4% unemployment, which is what they have in the SEP. I'm thinking more like something over 5%, which would be consistent with a mild recession in the United States. As I mentioned, the FOMC has not been successful at soft landings. Doesn't mean it's impossible. It just said we've never been able to do it before. So we may be lucky this time, but it's really hard to be lucky when you're raising rates really quickly. So, and not only are we raising rates quickly, but we're not the only country that's raising rates quickly. So around the world, in part because the US is raising so quickly, everybody else has to raise. Inflation's not isolated to the United States. Europe, the UK have inflation rates higher than in the United States. Now they would highlight that their oil dependence. So my baseline would be consistent with the 75 and 50, but I think the risks are on the upside as the inflation numbers probably come in not nearly as well as they're hoping. I do think that there are some significant downside risks to the economy, and I still think the risks on the upside for interest rates. And I expect progress on inflation will really require a mild recession in the United States to get the kind of pattern that they actually have in the SEP.